Okay, good afternoon, everybody. This is the weekly take on the market. Today's August 20th. It's Friday. The market's been closed for about an hour. I am traveling. I'm in Dallas, Texas for an IBD event. So I'm using my laptop. So bear with me. Hopefully this will sound okay and come out okay. The video was not working on my laptop for whatever reason. Maybe the camera's disabled, but the slides seem to be sharing just fine. I'll be your host. My name is Scott St. Clair. I'm a product coach here at MarketSmith. Here's the disclaimer. Take a moment to read that. Any stocks that are mentioned are not buy or sell recommendations. We are not licensed here at IBD. We're all about research, education, trying to teach you guys how to do this on your own. Here are the gauges. The market was lousy early in the week, but then I think today was a pretty good day. The market has a hard time going down for more than a day. So until it goes down and stays down, I'm just going to keep it at green. It's, you can argue that it's overdue. I know Justin Nielsen was talking about or emailed a stat that, the market hasn't had a 5% correction in like 32 years or something. And it is what it is. It's just totally resilient. And if you've been waiting and looking for it, you're just waiting and waiting. So just evaluate the market day by day, and it's the best you can do. Anything further than that, I just think is a mug's game. It's just too hard. You're just gonna frustrate yourself, really. The leadership, there's not a lot of leadership, but there are stocks to own. I don't own a ton of stocks, but I like what I own, and they're acting good. And so, and there's stuff that I wished I owned. So I think leadership is fine. And then progress this week in the portfolio. Okay, so let's go into the markets here. Let me just give you this slideshow, and then we'll do the industry groups. You guys know the drill. We're going to do 3 stocks. I am going to skip the quote of the week just for the sake of brevity. I left my deck at home, so my quote of the week for this week is on my desktop computer, and I just thought, I'll just save it for next week, okay? And then we will we'll do the 3 stocks, and then we'll wrap up. So let's go to MarketSmith Live. And sorry about that. It took longer than I expected. Just being on a single screen. At home, I have a bunch of monitors, so I love the idea of being able to navigate. But on this single screen on a laptop, I'm a little rusty. Sorry about that. So hopefully you can see a screen of the NASDAQ composite. You got a little bounce off the 50-day. Yesterday, you found support at the 50-day. The relative strength is still terrible. I don't know. I just don't know what to make of that. Till it matters, it doesn't. So here, I think I've done this before. There's the peak. There's another high in the NASDAQ, another low in the S&P, or the relative strength line. You take out that high, and the relative strength line, it's very subtle, but it's just slightly lower. And draw that very good. It's just slightly lower than that. You're pulling hairs at that point. But now, you're much higher again, and the relative strength is poor. So I don't really like that. That bothers me. That the breadth is poor, but everybody knows the breadth is poor. So it's like, is it a good indicator if everybody knows it? It's kind of the talk of the town on Twitter. So I'm more neutral on the market. I don't love the market here, but I don't hate it either. I am invested. I own 3 stocks. I'm like 45% invested in 3 stocks, and I'm I'm not, I'm only 45% invested, so it's not a lot. But I was glad I was 45% invested 2 days ago, and then sad today, and that's just the way it is. I'm not trying to benchmark, so I don't have to worry about matching the Nasdaq or the S&P every day, week, month, year. It doesn't matter to me. I think one of the undervalued things that people don't talk about are risk-adjusted returns. Everybody wants to tell you how well they did, but it's really hard to say, well, how well did you do with that type of risk? And so risk-adjusted returns are something I think about because I don't like to go backwards. So if the NASDAQ does 30%, maybe I do 25 because I'm peeling off into strength, and that's fine by me. But if the NASDAQ does negative 30%, I'm fairly certain I'm not going to do negative 25. I might do -9 or -12, but I'm not going to do negative 25. And that's just kind of the way I prefer to attack it. So the NASDAQ is just a little bit of an underperformer at this very moment. The S&P didn't quite hit the 50 days. You can tell it's obviously stronger than the NASDAQ. And then the Russell is the weakest of the three. I'm taking out the Dow. When I say the three, it used to be the Dow was the three, but we don't really consider the Dow much anymore due to the just too concentrated, and the merchandise in the Dow isn't all that spectacular anymore. So the Russell is just kind of going sideways, not doing a whole lot. Emerging markets are bordering on terrible. I mean, they're below the 200-day. Paul Tudor Jones would say nothing good happens below the 200-day. I think all bear markets occur under the 200-day. So, if you want to tell me that emerging markets are in a bear market, I think the evidence is in your favor if I were to try to argue otherwise. And, most of that is because of China just gotten, torched. Here's FXI, here's KWEB, which is concentrated in Chinese technology stocks. It's down 58%. So they've had a massive, terrible bear market. They're in the middle of one. And people are now deciding that Chinese stocks are uninvestable, which is funny. I don't know if they are investable or not. I'm not invested in any Chinese stocks, but I find it ironic that they're always uninvestable once they're down 58%. No one was telling you how uninvestable they were right up here at the highs. But this is a good chart to study if you want to study typical bear market action, right? So you break off the highs, you get a lot of distribution in here. Now, this is a concentrated index, but so is the NASDAQ, the QQQ, right? So you get a lot of distribution in there. You break off the highs, you break below the 50-day, you try to rally back up. But what once was the floor, if I'm going to go to the weekly, you'll see how the 10-week line was the floor for this whole rally up from mid-30s to 100, and now it becomes the ceiling, and the index or the market cannot get above that, right? And if we go to the daily, you can see it tried to rally, failed, tried to rally, failed, tried to rally, failed miserably, right? Because once it just cannot rally, then there's that waterfall where everyone who's waiting for the rally finally just capitulates. And you've got a little bit of that here in these last couple of waterfall declines. So this is actually kind of like textbook bear market action. And so if you're worried about the market, I think the first thing you'll get is you'll get some distribution, which we get once in a while. But then what our market does is it goes back. Totally different. It never stays down and lives below this 50 days. So if we start to get that type of action, then I would get uber concerned. But till then, the US is just beating its chest. It's just acting really, really well. Let's go to the industry groups. Steel producers back at number one. Nucor broke out maybe 3 weeks ago. TX broke out maybe 8 weeks ago. So that group has been pretty good. Retail is 2, coal is 3, just a strange top 3. Finance consumer loans is 4, probably a lot of because of the strength in UPST, Upstart, and so on and so forth. So I don't see a whole lot in the top 20 groups. It's kind of not an uninspiring industry group top list. It's just not, I won't say none, but very few of these groups inspire me to get super excited on the, the new. Are these companies changing the way we work, live, or play, like Bill would say? Those are the stocks that I prefer to own. Will I own a new core sometime? Sure. I don't know if I've ever owned a coal stock, probably, but maybe it's been a long time. UPST, it's really super volatile, been hard to hold for me, but I've owned it before. But I'm looking for that new, the big exciting new that Bill talks about. What Bill would say is changing the way we work, live, and play. So let's go into 3 stocks. Nvidia, amazing company, amazing stock. Super report, up 89% 2 days ago. Just broke out of this cup with handle today. We go to the weekly, see the breakout. Seems actionable. I'm sure a lot of you own Nvidia, have owned it. It's been a leader, and until it shows otherwise, it's one of the signs that the market's fine, because this is one of the leaders from the great bull market. Nvidia, Tesla is not as good, but hasn't broken down yet. This chart looks very toppy to me. I think if it was Tesla, more people would see it as being toppy, but if it did that, it wouldn't surprise me. This could turn out to be a big base, but the relative strength is very poor. Look at where the relative strength peaked at, and look at where it is now. It's really underperforming. It's being held up by the strength of the market. So I watch Tesla as a great what's the word I'm looking for? An indicator for the overall market. I think if Tesla were to break, that would be a sign maybe the market's not that good, or if Tesla breaks and the market just says, so what? Wow, that would just be really strong action. I think I did MRVI last week, but this is what I'm talking about. This stock that doesn't want to go down so far, breaks out, goes up 3 weeks in a row, just acting really strong. Made a new high out of this move today. So this is something I own, and just giving you no feedback that the market's in trouble. Even when the market was bad, not yesterday, but maybe it was 3 days ago, 3 trading days ago, it's just nothing. It's just sitting up there. DLO, another sign, crazy, amazing strength breakout, up 30% on earnings, up 100%. New name, not a lot of sponsorship just yet. The one thing I like about MRVI is the sponsorship. DLO doesn't quite have any sponsorship yet. We only have a 1 quarter of showing the sponsorship. But one thing that stuck out to me, which was enough for me to own, was Fidelity. I always like to see Fidelity in there. Look at how many, these are 2 Fidelity funds that I flagged. But you can see other Fidelity funds own this stock. So they've vetted the company. The earnings were up 500%, when I was buying it, and revenue up 124%. Now you have to sit through this earnings report, and it's everybody's got a different style. I sit through earnings report. I adjust position size sometimes based on volatility, based on how well I'm doing. But I never get completely out, because I don't know. I have a hard time getting back in. I just could never buy this stock at 60 when it opened there. I even owned it and had all and just couldn't pull the trigger on adding. I wish I had added some. So I own them through earnings, good and bad, and I'll have, this is highly unusual, of course, but I'll also have some that gap down, and hopefully through every earnings cycle, if I hold, 5 stocks, I get, two flats, one up big, and, two down big. As long as they're not down 30% or 20%, if they're down 5, 8, 10%, I can survive it and just get through the earnings report. But if you're gonna have a big winner, I'm 100% convinced you're gonna have to sit through earnings. I don't know how you're gonna get in and get out through every earnings report 4 times a year. You're just gonna get left in the dust like this. Nvidia's had big gap ups like this in history. Shopify, PayPal, a lot of them do. It's just part of the game now, unfortunately. So think about how to handle it. I don't have the perfect answer. I know some of my colleagues in house like to use like a 10% rule. I don't use that rule. I just, if I want to own the name, I'm just gonna own it through earnings. But like I said, I might adjust the position size. I don't want to be gambling on the earnings report. I just want to be able to have a position so I can handle it correctly if it does this. Also, handle it correctly if it does the opposite. If it's 50 and it opens at 44, what am I going to do? I want to be able to, not get frozen and cut the loss quickly if that's the case. There was one other name that was new. Oh, this was one that I do not own, and I don't know why. It's totally asleep at the wheel. But Task. So earnings are up 88%, gaps up on the earnings, goes through the pivot. I don't know much about this company yet, but must be doing something right. Two quarters in a row, very, very good. So there's a lot of new merchandise. There's been a ton of IPOs this year. So you extrapolate 3, 6, 9, 12 months from now, you're just going to have a lot of companies. Some of them are going to crash and burn. They're going to take that money, and for whatever reason, at this very moment, the market doesn't like what they're doing, or Path or AI, it just doesn't like what they're doing. Unity, ran up and then, builds this huge base. If we go to the weekly, you can see actually had a buy point comes out of this very first base, not including the IPO base. But this is kind of typical of what they can do on the IPO. But the nice thing is you got a lot of potential merchandise down the road, and these are the best companies. These are the ones you want to get to know. Bill talks about. I can hear him on a meetup I was listening to that he did in 2011. He was talking about the names. He was talking about Lululemon. He's like, Lululemon, what's that? What's that name? I don't know anything about that. Where are all the Google and Lululemon? Where are all the Smiths and the Jones? How come they come up with all these weird names? And it's because, he was just, what he was trying to say is that, look, this is new merchandise, and you have to learn to recognize that new merchandise and get to know these companies. Because this is the lifeblood of big winners. Is new. Sometimes really good old companies can go up a lot, but mostly it's these newer ones. So you really want to get to know them and have them on your radar. And admittedly, the IPOs are feast or famine. Honestly, the delocals are. This is more and more rare, in my opinion. Most of the time, they do what Path or AI did. Here's one that I have not owned, Docs. It was pretty choppy. So gapped, it tried to go up, then failed, and then gaps up on earnings up 700%. So maybe you had to try this one twice. So they're a lot harder for sure, but they're appealing to me because if you get them right, the upside is really big. And if you get them wrong, you lose the same amount, 5, 6, 7% that you would lose in any other names. All right, so let's go back to the screenshot for the contact information. All right, 800-831-2525. Reach us at marcussmith.com. Hopefully the video comes out okay. Thank you guys for your patience. I felt like that was a little slower than I'm normally used to, but I thought better something than nothing. At least that's the feedback that we get. Sometimes people will say, "Where's the video?" Have a great weekend, everybody, and we will see you next week. Bye-bye.